There are two completely separate skills in retirement planning. Most people spend 30 or 40 years working on the first one, and they never hear about the second one until it's too late to do much about it. The first skill is saving, knowing where to put the money, how much to set aside, which accounts to use. Most people who are serious about retirement, they've worked on that. They followed the advice. They've done the right things. The second skill is different. It's about how you take the money out, which accounts you open first, in what order, and why that sequence, that specific sequence, quietly determines how much of your retirement savings you actually get to keep. That's what this video is about. And if you've never really heard it explained this way before, that's not an accident. It just doesn't get talked about the way it should. I want to start with something that might feel a little uncomfortable. If you have money in a 401k, a Roth IRA, and a regular brokerage account, congratulations, you've been doing the right things, genuinely. But here is the question almost nobody asks. Do you know which one you're going to open first when the paycheck stops? Because that decision, that one decision, has real dollar consequences, not small ones. For some people, it can mean $40,000, $50,000, even more, paid to the IRS over the course of retirement that didn't have to be. I've seen it happen. People who saved beautifully for decades, who did everything right on the way in, and then, because nobody ever walked them through the withdraw side, they started pulling from the wrong account first. And by the time it showed up on their tax return, it was already done. So if you're within 10 years of retirement or already there, stay with me, because this is the piece that most retirement content glosses over, and I think it matters more than people realize. Let me set up the foundation quickly, because I want to make sure we're all starting from the same place. When it comes to retirement savings, you essentially have three types of accounts, three buckets. The first bucket is tax-deferred. This is your traditional 401k, your traditional IRA. The money went in before taxes. It grew without being taxed. And when you pull it out in retirement, that's when you pay taxes. Ordinary income taxes on every dollar. The second bucket is tax-free. Your Roth IRA, your Roth 401k, your HSA if you've used it as an investment vehicle. The money went in after taxes, it grew tax-free, and when you take it out, nothing owed, not a cent. The third bucket is after tax, a regular brokerage account. The money went in after taxes. Growth is taxed along the way, though often at lower capital gains rates, and withdrawals? Taxed, but typically at a lower rate than ordinary income. Three buckets, three different tax treatments. Now here's the thing. Most retirement content stops there, names the buckets, explains how each one works, and calls it a day. And that's not wrong. Understanding the buckets is important, but it is incomplete. And the part that's missing is actually the part that costs people money. Here's what most people assume when they retire. I saved into all three buckets. Now I just take money from whichever one I need. Sounds reasonable, and honestly, it's what I hear all the time. The problem is that each dollar you withdraw from each of those buckets has a different tax consequence, and those consequences interact with each other in ways that can quietly push you into a higher tax bracket than you ever expected. Let me give you a concrete example of what I mean. Say you retire at 65. You have $800,000 in a traditional 401k, $300,000 in a Roth IRA, and $150,000 in a brokerage account. You need $60,000 a year to live on. If you pull all $60,000 from the 401k, the tax-deferred bucket, that $60,000 is taxed as ordinary income. For a married couple, that lands you in the 22% bracket. That's before Social Security is even factored in. Now add Social Security. Depending on your income, up to 85% of your Social Security benefit becomes taxable. So now your effective taxable income is higher than $60,000. And we haven't even gotten to required minimum distributions yet, which start at 73 and force you to take money out of the tax-deferred bucket, whether you need it or not. The bucket that felt like the safe, responsible choice for 30 years, in retirement, it can quietly become the most expensive one to touch. Actually, and this is the part most people never hear, let me reframe what we've been talking about. Because up until now, I've been describing this as a problem with withdrawals, with sequencing. But the real issue is something slightly different. The real issue is that most people think the hard work of retirement is done when they stop working. And in one sense, yes, the accumulation phase is over. The saving, the compounding, the discipline, that part is finished. But there's an entirely separate discipline that begins the day the paycheck stops. And it's not about saving, it's about preserving what you saved. The tax code doesn't stop applying to you in retirement. In some ways, it becomes more complex, because now, for the first time, you have full control over which accounts you draw from, and that control is either an advantage or a liability depending on whether you understand how to use it. That shift from accumulator to distributor is something most retirement planning doesn't prepare people for. There's a phrase I use with people when we talk about this: the withdrawal sequence. It's not an official financial term, but it captures something real. The withdrawal sequence is the order in which you draw down your 3 buckets in retirement, and done thoughtfully, it can keep your tax rate low, preserve more of your Roth accounts for tax-free compounding, and give you significant control over your lifetime tax bill. The general framework that many financial planners use, and this is a starting point, not a prescription, because your specific situation matters, goes something like this. In the early years of retirement, before required minimum distributions begin, there's often an opportunity to draw from the after-tax brokerage account first. This keeps your taxable income lower. It gives you room. During that same window, especially if your income is lower than it was during your working years, this is often the best time to consider Roth conversions, moving money from the tax-deferred bucket into the tax-free bucket, paying taxes now at a lower rate so you don't pay them later at a higher one. Then, as distributions from the tax-deferred accounts become required at 73, you're already in a position where the tax damage is more manageable. And through all of it, ideally, the Roth accounts are the last thing you touch. They grow tax-free, they pass to heirs tax-free, and they give you flexibility that the other 2 buckets simply cannot. The sequence is not complicated, but it requires thinking about retirement income as a system, not just a collection of accounts. Here's the thing that I find genuinely interesting about this. The people who get this wrong are not people who weren't paying attention. They're often the people who were paying the most attention during the savings phase. They did the research, they maximized their 401k, they opened a Roth IRA when Roth IRAs were still new, they opened a brokerage account when they had extra to invest. They did all of that right. But nobody told them that there was a second curriculum. Because here's the reality. The financial industry, and I say this with respect, not cynicism, is structured around accumulation. Products are sold based on how money grows. Advisors are often compensated on assets under management. The whole conversation is oriented around building the pile. The distribution side is quieter, less marketed, less discussed. And I personally think that's one of the most significant gaps in how retirement is explained to people. Not because the information is hidden, it isn't, but because nobody is packaging it clearly and putting it in front of people at the right moment. This is not about right or wrong. It is about understanding your own trade-offs, and most people just haven't been handed the full picture. I want to spend a moment on required minimum distributions, because I think this is where the surprise most often lands. If you have a traditional 401k or traditional IRA, the IRS requires you to start withdrawing from those accounts at age 73, and the amount is calculated based on your account balance and a life expectancy table. You don't get to choose whether you take it. You don't get to decide you don't need it that year. For people who have been disciplined savers, who have a significant amount in their tax-deferred bucket, those RMDs can be substantial, and they land on top of any Social Security income, any pension, any other income source. The result? A tax bracket that's meaningfully higher than they expected. And in some cases, it's high enough to affect Medicare premiums, a surcharge called IRMAA that most people have never heard of until they receive the letter. According to Fidelity and multiple planning frameworks, the people most affected by this are often the ones who saved the most diligently in tax-deferred accounts, because that's what the conventional advice told them to do for decades. The right decision depends on your numbers, not someone else's situation, but the general principle holds. A large, untouched, tax-deferred account can become surprisingly expensive by age 75 or 80. Which is why the years between retirement and 73, if you retire before then, are often the most valuable planning window most people don't know they have. Let me say something about Roth accounts that I don't hear said clearly enough. Roth accounts are not just a savings vehicle. In retirement, they're a pressure valve. When your tax-deferred distributions are higher than you want, when a large expense comes up, when you want to make a charitable gift, when you want to take a vacation without it affecting your tax bracket, the Roth account, because it comes out tax-free, gives you options that the other two buckets can't. And because Roth IRAs have no required minimum distributions during your lifetime, they can sit and compound for years longer than your traditional accounts. That makes them excellent for legacy planning as well, for whatever you want to pass on. The instinct for a lot of people is to treat the Roth like a last resort. I'll leave that one alone as long as possible. That instinct is actually correct, but it needs to be intentional, not accidental. There's a difference between preserving Roth accounts because you understand why, and just happening not to touch them because you're drawing from the 401k out of habit. I mentioned Roth conversions earlier, and I want to come back to them briefly. A Roth conversion is when you take money from a traditional IRA or 401k, pay income tax on it now, and move it into a Roth account where it grows tax-free going forward. It sounds counterintuitive. Pay taxes now? On purpose? When you don't have to? But here's the reasoning. If you retire at 62 or 65, and you're not yet 73, there may be a window, potentially several years, where your income is lower than it was when you were working, lower than it will be once RMDs start. That window is an opportunity to convert some of the tax-deferred money at a lower rate than you'd otherwise face. According to research from J.P. Morgan Asset Management and Vanguard's planning frameworks, strategic Roth conversions during the early retirement years are one of the most effective ways to reduce lifetime taxes for people who have significant 401k balances. This may not apply to every situation. Your specific numbers matter more than general rules. But for many people in their 60s who haven't thought about this, it's worth understanding that the option exists. And the window doesn't last forever. Once RMDs begin, your taxable income increases whether you want it to or not. I want to be clear about something before we get to the ending. Everything I've described is a framework for thinking, not a formula to follow blindly. Tax situations vary, state taxes vary, Social Security timing varies, healthcare costs vary. What works well for one household may not be optimal for another. But here is what I want you to take away from this. The three buckets are not interchangeable. Each one has a different tax character, and that character matters enormously in retirement. The order in which you draw from them, the withdrawal sequence, is a real planning decision, not a footnote. The general sequence that financial planners often work toward for people with all three bucket types: draw from after-tax accounts first in early retirement while keeping income low, use that same window to do Roth conversions at a lower rate if it makes sense, let the Roth accounts grow, Then, when RMDs begin from the tax-deferred accounts, you've already managed the size of that bucket, and the tax hit is more predictable. That sequence, roughly after tax first, Roth conversions in the middle, Roth last, is not a rule. It's a starting point for a conversation with someone who knows your specific numbers. Here is what I want you to take away from this. Not anxious, not overwhelmed. What I want you to feel is that you now understand something that gives you agency. Because here's what I've noticed talking to people who are approaching retirement or already in it. The fear is usually not about the big, dramatic things. It's about the quiet suspicion that there's something they don't know, something they should have learned, something that's quietly costing them and they can't see it. If the three-bucket strategy, and specifically the withdrawal sequence, is one of those things, now you've seen it. Now you can ask the right questions. Now you can have a different kind of conversation with a financial professional. That matters. That is worth something. If someone you care about is 5 or 10 years from retirement and still thinks the hard work is done, this is the video to send them. The saving was the first half. The sequencing is the second. And the second half is the one that actually shows up in your bank account. You built these accounts over decades. Understanding how to use them in the right order is how you make sure that work actually pays off the way you intended. I know this isn't the most exciting topic. There's no big dramatic moment where everything suddenly changes. It's just a quieter kind of clarity, the kind that makes the years ahead feel a little less uncertain. That's enough for me. If this one helped you see something differently, that is all I ever hope for. Give it a like if it was worth your time, and if someone you care about is figuring out retirement right now, share this with them. I will see you in the next one.